When you have a business, you will have to record all the transactions in the business. So we will start with the source documents that's completed for every transaction. We use these source documents to record it in the journals. From the journals, we will post it to the accounts in the general ledger, and then we will draw up a trial balance to ensure that we've completed the entry for each entry on the debit side and one on the credit side of another account. After we are sure that the entries were all recorded and the trial balance is balancing, we will use the figures in the trial balance to prepare the financial statements. So the first thing that we must remember is the whole purpose of a business is to make a profit. So the first financial statements that we will record will be the statement of comprehensive income. It was always called an income statement, but internationally the name changed now to a statement of comprehensive income. So it means in this statement we will write all our income and expenses to determine the profit. So the main purpose of a service undertaking is to render services for an income, and that income after expenses will give me the profit. This is, for instance, businesses like a lawyer, hairdresser, plumber, electrician. So they don't sell goods, they render a service, they receive an income, they have to pay expenses, and if you subtract the expenses from the income, you determine the profit. The purpose of a retail business is to buy goods and sell it at a higher price to make a profit. So they're not rendering a service, they buy and sell goods, and in that way they make a profit. So at the end of the financial year, we will take all the nominal accounts, that means all the income and expenses for that specific financial year, and we will record it in the statement of comprehensive income. So first of all, we will write down all our income, see what is the total amount of income, then we will write down the total expenses, see what is the total expenses, deduct that, and that will give me the net profit. And this net profit will then be transferred to the capital account because the owner is entitled to the profit. Now, the whole purpose of the financial statements is that we must look at the statements and we must analyze the figures so that we can make decisions for future, that we can have a higher profit in the future. So if we're not satisfied with the profit that we're making at the moment, we will have to see how can I improve my income or how can I decrease my expenses. So say for instance, it is a service undertaking and my profit is not good enough. Then I have to consider if we can render another service in this business that can give us an additional income so that my profit will increase. Or in a retail business, we will decide which other products can I also sell in this business to increase the profit that I make. For the expenses, you will have to look at every expense and decide which of these expenses are too high. So say for instance the telephone account is very high. Then you must make a decision, how will I reduce this expense? So you can, for instance, link the telephone of all your employees to the computer. At the end of the month, you print out a copy of each of the employees, indicating all the numbers that they phoned during the year, how much time they spent on each one of these telephone calls, and they can determine, was these calls to private people or was it for business purposes, and then make the decision that you can have a certain amount of telephone calls in a month. If you exceed that, the employee will have to pay for the rest. Or if, for instance, our expenses are very high and we see that the salaries is very high in comparison with the profit that we make, we will have to decide whether we must let some of the people go. So we give them a packet and we say there's the salary for the next 3 months, and in the end you decrease the amount that you spend on salaries, and the rest of the people that's still working there will have to do all the work of the people that left because the profit was not big enough. So the whole purpose of the income statement is to determine what is my income, what is my expenses, what is my profit. And then I must look at all my income and expenses and decide, how can I improve the income, how can I decrease the expenses so that I can increase my profit. So there's a lot of different income. There can be services rendered as well. There can commission income. So any income that you receive will be added together. Then for the expenses, you will take all the expenses, cleaning materials, wages, and all the expenses in the business, and you will see what is the total expenses and how can I reduce expenses. So the purpose of the income statement is to determine what is your profit and what must I do in future to improve that profit. Okay, if we look at the statement of financial position, previously it was called the balance sheet. This business reflects the balances of all my accounts, assets, liabilities, and equity on the last day of the month. So I will take the end of the financial year balances and I will record it into my balance sheet. Okay, now remember, assets equals owner's equity plus liabilities. So it means the top part of your balance sheet will consist of assets. The bottom part of your balance sheet will consist of the equity and liabilities. And when we finish with the balance sheet, the total of all your assets must equal the bottom part of your balance sheet, where we take the equity and liabilities into account. Okay, if we look at the assets, we must divide assets between non-current assets and current assets. So the land and buildings, equipment, vehicles is called fixed assets, and investments is my investing facilities. So that is my non-current assets. Then all the money in the bank, inventory and debtors will change regularly over a short period of time. So this is my current assets. So the assets that will take a long time before they change is non-current. The assets that change on a regular basis will be current assets. The same will be done with liabilities. So for loans, for instance, I can obtain a mortgage loan where I give my property as security to obtain the loan, and I have 25 to 30 years to pay it back. The ordinary loan that I obtain to buy a car, for instance, we pay back over a period of, say, for instance, 60 months. So it means the loans, whether it's mortgage loans or normal loans, will be paid back over a very long period, more than 12 months in the future, and that's why we call it non-current liabilities. Creditors must be paid at the end of the month or every 60 days according to the agreement with the creditors, and this is short-term liability because I have to pay it regularly, and this will be a current liability. So the whole purpose of the financial statements is to see in the income statement whether we made a profit and how we can improve that profit. The balance sheet, we want to look at our assets, liabilities, equity, and see how I can improve the situation in my balance sheet so that I have a better result in the future.